everyone, and welcome to Economic Impact. Today, we are Feb 14, 2024, and as usual, I am with our Chief Economist, Stéfane Marion. Hello, Stéfane.
Denis, February 14, thanks for being my Valentine.
Oh my God. Okay, let's start, okay? Today, I think we need to talk about the equity market once again because we had a new high.
Yeah, it's been staggering since last November, Denis, when the U.S. Federal Reserve opened the door for potential rate cuts in 2024. So yeah, a new high early in February. We are actually surpassing the previous record that was established at the very end of 2021. So it's been an unusually strong performance since November.
And it's not across the planet though. It's more North America and a lot more US.
Yeah, so 2 months into the year almost, global markets up 3%, mostly driven by US 4%, Japan up almost 12%. But look at the rest of the world, Denis. I mean, the impact of previous rate hikes is starting to impact maybe not the US so far because there's been tremendous fiscal policy or momentum in the US with the IRA, but elsewhere around the world you can feel that there's slowing growth there. So yes, it's new record, but mainly on the back of the US and Japan.
Yeah, good. And one of our favorite subject, inflation. Once again, we had the US number yesterday. It was a bit surprising.
So there you go. The market is up since November because the Fed opened the door for potential rate cuts in 2024. But all of that is very much dependent on what happens on inflation. So expectations of rate cuts may need to be reassessed given the latest number on inflation. Yes, overall inflation is at 3.1%. And we're way down from the 9% that was observed in 2022. But core inflation, which excludes food and energy, is at 3.9%. It's actually accelerating on a month-to-month basis right now. So I think there will be rate cuts this year, Denis, but we actually, in our current forecast, we pushed them back to the third quarter of this year. And the market was expecting not too long ago potential rate cuts as soon as March of this year. So from a stock market perspective, you may need to reassess your expectations because the longer the Fed delays its rate cuts, the more there's a potential for a deleveraging episode in financial markets.
Remember, not that long ago, we were expecting rate cuts late in 2024. We changed our mind because we saw a big deceleration in inflation. Now we're back to square one, almost.
It's hard if you're a central bank or to calibrate models in the current context. And don't forget, the commercial real estate is yet again becoming a concern for regional banks in the U.S. And under these circumstances, again, the longer the Fed delays its rate cuts, then the more you're likely to see collateral damage in some parts of financial markets. That's why we say there's never been ever before a monetary tightening cycle without one episode of deleveraging, and we have yet to see it.
Yeah. If we're back in Canada, we look at inflation once again. Not same number, but same direction, but for different reasons.
Yeah, the Bank of Canada, unlike the U.S., hasn't been as aggressive in guiding towards potential rate cuts, and for good reason. Unlike the U.S., the Bank of Canada is struggling to see through shelter cost inflation, which is running at 6%, which is unprecedented at this point in the monetary tightening cycle. It should be coming down, but it's stuck at 6%, Denis. And the Bank of Canada last week actually acknowledged that, yes, we know it's shelter costs, we don't control it, but we can't ignore it. So therefore, at this point in time, they're not promising imminent rate cuts. So in Canada also, I think we pushed back our rate cut expectations to the second half this year.
Yeah, and we thought that housing affordability was getting in the right direction, but once again, numbers show that no, not exactly. And especially it's the same across Canada, but at different level.
It's not good, Denis. So yeah, you're right. Shelter cost inflation reflects the fact that home affordability is deteriorating quite significantly. In Vancouver or Greater Toronto area, households have to devote 90 to 100% of median income to purchase a home. Not going to happen, right, Denis? It's the worst affordability in over 2 generations. You got to go back to the 1980s. And it's across the board. Not so much in Alberta at this point in time, but the rest of the country clearly struggling with an affordability crisis. I would depict it that way.
And once again, another, in fact, landmark, working age population surged once again in January, which is a huge number.
So I can't bring down affordability. People are saying it's going to come down if rates come down. Denis, it can't come down if your population continues to surge because that's higher demand for housing. So we spoke to what happened in 2023, population growth of 1.2 million people. We're starting the year with 125,000 in a single month, the month of January, Denis. It's a new historical record for Canada on a monthly basis. In the Greater Toronto Area, for example, the largest metropolitan area in Canada, it's 32,000 people per month right now. That's 25% of Canada's population growth is happening in the Greater Toronto Area, which is putting tremendous pressure on the public finances of the fiscal house of municipalities across Canada, but particularly in the Greater Toronto Area. So I can't improve affordability with this type of population surge.
And once again, it's because rates are still high, not to help, building permits are going down, which is creating more problem.
Well, Denis, everyone knows you have to calibrate your immigration policy given where rates are. And if rates are high, property builders are just not building right now. So the government says we need more supply. Yes, but the rate structure is not conducive to more supply. So we have surging population with building permits plummeting across most metropolitan areas. Look at the GTA, Vancouver, Montreal, only Calgary is trending up right now. But if not, it's multi-year lows. So you have population at a multi-year high with building permits at a multi-year low. So that's not going to improve affordability anytime soon.
No. And at the same time, we're trapped in what they call a population trap, which is an economic kind of a subject.
So it's, we wrote a piece on that, and the idea doesn't come. We didn't invent the term, Denis. It was invented by Robert Solow, Nobel Prize in Economy, who argued one day that, you can grow your GDP, your economy through population up to a certain extent. There comes a point that if you don't have enough investment in the country, where your population increase can no longer lead to improving living standards. So the population trap that we're seeing in Canada is historical, it's unprecedented. Normally it's the preserve of emerging markets with high natality rates, fertility rates, not the case in Canada, which is driven by immigration. So again, we're very much for immigration as long as the government is able to calibrate for where we are in the cycle. Notice on this slide that the U.S. has experienced a brief population trap after the 2008-2009 financial crisis when banks stopped lending, collapse in the banking sector, but it rebounded. But look at the extent of the population trap in Canada at this point is what? 5 times greater than the U.S. during the Great Financial Crisis. So hard to get out of that. So all I'm saying here is we know immigration. We have to welcome people with dignity in this country. And right now, given the capacity, the first 300 to 500 people get access to certain services, and the balance, all the way up to 1.2 million, well, they're not welcome to the country with dignity because we don't have the capital or the services to go along with that. That's why we have to recalibrate on that front, because if you don't improve the population trap, Denis, living standards are not going to get better anytime soon.
Yeah, and we need to do it sooner than later. And you just mentioned it, standard of living is going down in Canada because of all of that.
So this is the concept that what leads the clear indication that you're in a population trap is when you look at your capital labor ratio and then you compare that to your per capita GDP. And right now, living standards in Canada have been eroding. They've been at a standstill for almost 6 years, and they've been eroding in 6 consecutive quarters, which is almost unprecedented for the country. So again, it's just a question of recalibrating given where you are in the cycle. That's why we're advocating for Ottawa to put in place a special committee of experts that could actually advise the government on what the country can absorb in terms of population at any point in time, given where you are in the cycle. I think we have to depoliticize this whole thing, and we have to get the overall number of what the country can absorb. Again, it's just a question of welcoming people with dignity. If not, we're going to have a reputational risk internationally if we can't welcome foreign talent with dignity.
You're very right on that. Well, once again, it's very interesting, Stéfane. Thank you very much for being with us. And thank you also, all of you, to watching us. And hopefully we'll see you once again in the beginning of March. Thank you.